On this episode of Through the Pines, we'll cover the differences and the pros and cons between fads, bubbles, speculation, and the stock market. Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while retiling his kitchen. This is Through the Pines. Our advisors for this episode are Rex Baxter and Brandyn Smith from planwithbaxter.com. That is Plan with Baxter, Baxter. Do you ever spell it wrong, Rex, yourself? Put an S or anything in there?
No, but the most common misspelling is Backster.
Oh, really? Really?
Yeah.
Okay. I would not have ever gotten to that one, but
so let's not make that mistake, people. It's Baxter.
Baxter, Plan with Baxter, and they're the 2023, 24, 25, and 26, which I need to update my notes. Forbes Best In-State Wealth Management Teams for Utah. So 4 years running. Advisor Hub, fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award. And so let's dive into the topic, fads and fundamentals here, Brandyn. And pretty much, there's fads, bubbles, speculations, and then there's like what actually happens, right?
Yeah. And thanks for having us on. I like this topic because I think rarely do people understand the difference between a fad, between a speculation, between a bubble, between a fundamental investment.
Okay, so just right out the gate, let's go through an example really quick. Can something like gold be a fad?
Yeah. The gold bugs out there would say, hey, no, this isn't a fad. Gold has been around before money, and people have always liked gold, and that's true, right? Like there, as long as society is in some semblance of right, because like if society's completely melted down, people they don't care about gold. They care about food. Right.
And see what we did there with the melted down. This guy's on.
I like that. Man, that was slick.
They care about food, protection, shelter, right? That's what, but then once society kind of puts itself together a little bit, gold is kind of a rare mineral that is shiny and people like and can be used not for that many things, but is useful, right?
Well, it's easily manipulated, right? And so you can put it into jewelry. You can, that's why gold is valuable. It's not just shiny, but that's what gives it its value is because it's malleable.
It's malleable, but you don't always want malleable metals. I don't know, right?
Yeah.
So it can be a fad, or it can.
So gold. We shouldn't call gold a fad because it's been around forever, right? But
I would disagree with that.
But the value of it
when it's a fad.
Oh, let's hear it, Rex.
Right? I think that when it becomes such a social media frenzy and it becomes it's so pumped up as far as in the media attention and in it's the cool thing to do for a minute, then I think it turns into a short-term fad. And I think the underlying case is the fundamental of gold still has some core value in there. But I think that there's times when it becomes very faddish with that and silver and other precious metals. Right. And so, and I think that the easy way to spot that is when you're on, you're watching a TV show and you have, 7 out of 10 commercials talk about gold coins, right?
Happens all the time.
Well, and I think the other thing to look at is if something, like if a stock doubles in value, the first question I'm asking myself is why? Right. And if I look and I see that their earnings have also doubled in value, if they've literally become twice as profitable and that's a long-term trend that's not going to go away, then that makes sense. I'm like, oh yeah. And are they going to continue to double in the future? Right. Are they going to continue? That's a very rational, logical question. But when you get something like gold and all of a sudden it doubles in value relatively, overnight, the question is why? Did it become twice as valuable? And maybe it did, right? But what would cause gold to become twice as valuable overnight?
And gold, it's just supply and demand, right? All it is. When you bear it down to its basic essentials, the thing that's going to drive gold up is demand. And the reason people typically are buying gold is they're scared of the economy, is they're scared about what's going on politically, in the world. Or they're concerned about the currency in their own country going to zero. And so they're thinking, okay, this can replace my currency, or it's easier to do this as a hedge so I don't have to go buy a different foreign currency.
Yep.
But those are the fears playing at what's driving gold up or down.
But those are the rational fears, right? And most times when I talk to people about gold, that's not what they're saying.
Are they rational though? I mean, sometimes they are. Sometimes
Sure.
they're not.
Well, I think that's a rational fear. Now, does that mean it's actually likely going to happen or have a high probability? No, but that's a very well thought out rationale for why someone would want to buy a bunch of gold.
Yeah.
Wow, I didn't know I touched on a subject that was so controversial between
Well,
you two.
we've thought about it a lot.
We get this question a lot.
Yeah.
Yeah. Okay.
You know,
well, all right. Well, let's sort of go back to basics on the podcast topic itself and define what maybe a fad is. Brandon, you put in here a short-lived social or consumer movement that drives temporary enthusiasm and investment interest. But my question for you would be, short-lived, can a fad be 10 years or something? And when, what is short-lived? And now I'm thinking like a coin base or something, something that like, is that short-lived or is that a fad, or how long does it have to be stable or whatever, or give returns for it to no longer be considered a fad?
Yeah, 10 years feels very short to me.
Really? Okay.
Oh, absolutely. If I was looking at investing in a company, it's like, hey, but it might not be around 10 years from now. Oh, that's terrifying, right? Like, because as soon as everyone else figures out it's not going to be here 10 years from now, the value goes to almost nothing. Because a lot of times when you're buying a stock, most times you're buying not just like the returns, the dividends of today, but more so the potential for future growth of dividends and future dividends. And if those are going to zero in 10 years, that's short term. I think with fad, we're not thinking of typically gold, right? We're thinking of more like social contagion, like axe throwing or, crazy expensive cupcakes or, right now it seems, and maybe it's just my algorithm, but like saunas and wellness are popping up everywhere, right? Cold plunge and sauna, which I love. I love all of these things, right? And they're a lot of fun, but sometimes, can a society sustain that level of excitement for that activity into perpetuity? Maybe, but sometimes you see them do really well at first and then start to kind of fade away.
Rex?
Yeah. Well, two things hit me. One, we might get some hopefully not hate
right. I don't
comments,
wanna,
right?
Yeah.
Because a lot of these industries we really like. I mean, I like gourmet cookies, and yet gourmet expensive, $10 a cookie may be a fad,
And
right?
and is it?
I hope it's not.
I hope the $10 cookie
They're the
is,
best. They're so good though.
However, just because it's a fad or temporary, and you're the investment advisors, does that mean like, because hey, if you're in early on that stuff, you can make a lot of money.
Sure. And so you need to understand what part of your capital you're allocating towards those kinds of investments, right? And so if you want to allocate a couple percent of your overall investment portfolio towards chasing fads and seeing if you can hit a few of those
2%, Rex.
I said a couple.
That's 2.
All right, a few.
10 maybe? Okay.
10 might be a little high.
Okay.
But, and so I would probably keep it under 5 or something like that. I mean, that's kind of
that just
a
seemed
random
really
number,
low to me, but okay.
But it's high risk. I mean, it's ultra high risk things.
Okay.
Yeah.
And so you don't want to risk your lifetime goals on something.
On chasing something that is
That's
popular
that
in the
risky.
moment.
Yeah.
Something. Now, Brandon, you said 10 years as far as if a company's not going to be around in 10 years, I would invest in it. However, I think you have this on the top of your head, but what the amount of churn or turnover in the the Dow, hasn't the entire Dow turned over in like the last 50 years or something like that?
I don't know the stats on the Dow. I mean, S&P 500 is always kind of adding and move, because I mean the S&P is just following the 500 largest, 500 give or take, right, largest U.S. based companies, and so you're going to have that kind of switch around a little bit. I don't know what
I'd have to look on the Dow, but it seems like there's about a third. So the Dow is 30 companies, right, and it seems like a third of the companies are still the part of the original. And so I think there's still a core base that's been there for 100 years.
Okay. Well, that's good to know, because I thought there was like a stat where it had like all turned over at some point or something.
Yeah, I don't think it's fully turned over,
Okay.
but I do think when you talk about 10 years, you look at a company and companies will have what's called a price to earnings ratio, right? You take the price of the stock and you divide it by the earnings, and it gives you a number.
I hear it as PE.
You hear it as a PE ratio, right? And so a lot of times people use that PE ratio to gauge whether a stock is expensive or inexpensive. And when you look at the PE ratio of the average S&P 500 right now, you're sitting at a PE ratio of maybe 18 or 20. And what that really means is it takes 18 to 20 years of those companies to earn enough to cover today's price.
Well, that seems high.
And so it's just a number at the moment, right? You've got to use it in context of what historically is it and things like that. But if it takes 20 years to earn today's price, and you're talking about 10 years being long for a trend, I'd say no, right? I mean, if it's going to take your company 20 years just to earn today's price, and a lot of tech companies may be at 30 or 40, on a PE ratio.
And you might say, well, what on earth? Why would you do a 30 times PE ratio? And it makes me nervous too, right? But the reason you do that is because you anticipate the future earnings going up higher than they are today, right? The earnings growth being there, which is in fact what we've seen is accelerated earnings growth, which some people argue that justifies the price. Other people say, yeah, that still feels a little bit high, right? And I think it's important to, when you're building your portfolio, to know what you own and know what risks you're taking. I think one other last thing on fads is just human culture is always changing. I remember when I was a teenager, we loved wakeboarding. Like wakeboarding was our thing, right? And we'd go and all the old timers would be like, no, skiing, and they'd have their old ski boats and they loved the teeny little the wake behind the boat, right? And wakeboarders, we were trying to get the big. And I remember thinking, consciously as a teenager, thinking, man, it's too bad all these like really nice wakeboarding boats are so expensive, but give it 10, 15, 20 years and they'll be older, and then I could buy one for cheap, like I could get a sweet wakeboard boat. And then I thought, will there be something new? Like no, wakeboarding will always be fun. And here we are, right? I mean, wakeboarding's still there, but it's surfing, right? Surfing's the cool thing. And I love it way more than wakeboarding because I don't get hurt as much. But it's just funny, right? That how much culture and ideas change, and businesses have to be able to adapt to those changes.
Rex, you're going to kill me for this question, I think. But I think you probably get this though. And how much do you have to talk people off the ledge when it's like, yeah, but I really need stock in this gourmet cookie company or something. Like I really need to, because when I go hang out with my friends, I want to be able to say I'm invested.
Sure.
In this thing that's a current fad.
Yeah. And a lot of times we talk about it kind of being what we call a cocktail party stock or a party stock that
and that's
you want to be able to talk
right?
and read about. It's absolutely a thing.
Okay.
It is interesting because human nature, it's easy to get people excited about something, right? On potential, on the future. It's easy to talk.
New is always exciting.
Absolutely.
Yeah.
Right? Everybody wants the newest, hottest red dot. And they always want to feel like they're in the know and they're part of the hip crowd. And so, these are things that are really easy to sell. And so people will sell their newsletters about the newest, hottest trends. And typically it's fads, not trends, but marketing is fantastic, right? We all love marketing.
Yeah.
And so, that's how they make their money, is not necessarily on the stocks themselves, but on the newsletter that they talk you into buying. But yeah, we get calls all the time about, hey, I heard that this, nuclear energy area is going to blow up and be fantastic.
Wrong word.
Oh yeah, wrong word. Sorry. No pun intended there. No pun intended.
Trying to short the stock.
Yeah. Or I heard that this
flying vehicles.
Flying vehicles are all the rage, or whatever the case may be.
Well, droids, robots.
Yeah, robots, right? That are fully autonomous.
Yes.
Right.
By the way, can't wait. Please make that like affordable, Elon, ASAP.
So make that a thing.
I can put it in my mom's house. That'd be fantastic.
So there's all these types of, and it's so easy. So we get a lot of calls about, should we have some of this in my portfolio, or why don't we, or do we have it? Where's it at in my portfolio? And so we get a lot of those phone calls. And again, we have to have the conversation of how much is appropriate. Should we have any? Is it a fad? Is it a trend? Is it the layest bell bottoms of the 70s? Is it whatever it is?
But how do you know? Because it is hard now. Fashion's one thing, but it's like, well, if you're not wearing bell bottoms. Who are you? When it's in fashion, it's in fashion for a reason. Everybody has it. And that's something that you get swept up in the moment, and you think could potentially, well, this isn't going to be a fad. This is going to last forever. So how do you know?
Yeah, you convince yourself, right? And the way that we know is that it has fundamentals, right? Is it has earnings, it has growth potential, it has the investment properties of being able to last through longevity, and it's been proven as such. Yeah, and so
cash flow will fix a lot of things, right?
Earnings, cash flow,
yeah,
with the business.
Yeah. Revenue will fix a lot, because ultimately, what does it come down to? All companies need to be flexible and be able to pivot, right? Those companies that can't pivot, that can't think, that can't change, the odds of staying around go down dramatically. And I think most well-established businesses are good at that, right? Executives get paid a lot of money, but a lot of that compensation is in restricted company stock, meaning that, hey, no matter what, you've got to figure out how to make this company profitable over the next 5-10 years. And so, nobody's, not all companies will figure that out, but most will. And so, I mean, but how do you figure stuff out if you don't have revenue and you don't have cash flow? Well, that's really hard, right? Because then you're convincing someone else with a lot of money to keep dumping money into this thing that isn't producing money.
And it's hard for you guys. You're the investors, because there's companies, what was it, Amazon, that just didn't make a profit forever. And like, there's companies that don't turn profit
Plenty of companies,
for a long time, but the potential is huge. And so everybody wants to invest in them. And that's your job, Rex.
Yeah, it's a investment analyst job, right? It's a job to sit there and look and say, is there a path to profitability? And what does that look like? And then you have to be able to innately look at that and say, is that logical? Is it going, do we feel like there's a high probability of that path going to happen? Or are projections just made up on hype and on hope and wishes?
So fads are fun. And before I get to the cons of fads, I was reminded, you said marketing, and I was reminded of the news story in the last 24-hour cycle of the, I think it was local, of the lady who, bold marketing technique, broke into homes, cleaned them, vacuumed them, and then left an invoice and a phone number to say, like, you should hire me to clean your house. Did you see this? Right?
No, terrible.
Bold move.
Bold move.
Didn't go over
Terrible
well.
idea.
She was arrested for breaking and entering, but these people's homes are clean. So
I don't think that becomes a fad.
No, but oh my gosh.
What a marketing ploy.
Props to ingenuity, I guess. I mean, anyway, but fads are fun. Fads are fun, and we want to be on them, but they can also be not good. And so, like, no staying power, there's high business failure rates. So something can trend quickly and then go away just as quickly. And then Rex, not suitable for retirement funds. And you were saying like 2% maybe in your portfolio.
Well, I think a small percentage, right? If you want to allocate a portion towards high risk, high octane investment ideas, I'm fine with that. But it depends on where you're at, what stage of life you're in, right? If you're in your early 20s, it probably could be a much higher percentage. Take some risks and things like that. If you're nearing retirement, or you're in retirement and you're living on your investments, then it should be a much lower percentage. And so it just kind of depends on the stage of life you're at. It also depends on your net worth and your capital, right? And so if you sold a business for $100 million and you only need 10 million of that to generate the income that you need to live, then you have a lot of money, above and beyond that you can take some discretion with and go and try and pursue some flyers and some high octane investments.
Flyers, high octane. Love that. Good words.
Yeah, big words.
Okay, Brandon, let's move on to the bubbles, like when hype detaches from reality. So the definition, asset prices rise far above fundamental value, and we sort of touched on this, due to the mass psychology of herd behavior. What are some examples of that?
Yeah, we all have it. And I think there's, a lot of fads and bubbles, you maybe kind of get a little intermingled, right? But my favorite one, and we've talked about it before, is the tulip.
I love this tulip thing. And I love that I've never heard of it until you brought it up a few podcasts ago. And I'm like,
right, it's just wild.
It was a big deal.
Yeah, over in Europe, people all of a sudden started deciding in the 1600s, started deciding that tulips, the flower, were very valuable. And it reminds me of so many other bubble type things, right? Where people are like, no, this has a value. And does a tulip bulb and flower have value? Yeah, sure. It's beautiful, right? Like, but how much value, right? And the value all of a sudden just exponentially started increasing to the point that people are like, man, if I can buy some tulips today, like get a whole shed full of tulips bulbs, right? Those will be worth this much more next year, and I'll be rich. And it did. It exploded, and people made crazy money on it, and people lost lots of money on it because ultimately the tulip crash was a zero-sum game, right? For everybody that lost their fortune in tulips, someone else gained a fortune in tulips, right? Because the value of tulips really didn't change, right? It's just well, it did change, right? But the intrinsic value of a tulip didn't change. And so you had a lot of people put a ton of money in and pull out at the right time, and a ton of people put a ton of money in at the wrong time and lose it, right? And so it's one of those great lessons of history to really understand, all right, what is backing up value? Because at any given point, someone might wake up one day and say, this is just a flower, and it's all over.
Yeah, it reminds me a lot of the .com bubble, right, of the late 90s, to where you had, a couple of fads at the time were that if anything ended, you wanted your company to end in .com. That was kind of the fad. You also wanted, everybody needed and wanted a website or a URL at that point because it was the cool thing to do. Now that piece has become a core tenet of business. Most businesses do need and have had a website for a long time, and I see that continuing for a long time. But the .com bubble, it seemed like as we went through that fad then became the bubble, the investment bubble that all companies got caught up in, whether you had fundamentals or not, that it drove the entire sector to astronomical levels. And then when it burst, then it hurt all of the companies. Those with fundamentals came back down to their intrinsic value and to their value, maybe even a little bit below, and then it rebounded back up. And those that didn't have fundamentals went away.
Rex, talk to me about the housing bubble, because that's a bubble. Like it's a bubble, and this kind of, I think it's more like the .com, but I don't know. But the housing bubble is like everyone, like you had like everyone wants to buy a house.
Yeah, but everybody wants to buy a house, but not everybody qualifies or should buy a house.
Yeah, and that was the problem.
And that's what the problem was of the real estate bubble of 2006 to 2007 and 8, is that the lending standards became so loose that not only did everybody want to buy a house, but the financial institutions made it so that everybody could buy a house.
They were using things like stated income, which means you come in and the banker says, hey, if you want to buy this house, you'll need to tell me you're making $200,000. And the person's like, yep. And like, perfect.
Well, and this gets a little more high level into policy as far as us here in the United States goes, because that was politically good for the people. It was like, we're roaring, we're killing it. Right. Everyone's buying houses, and I'm behind the scenes doing loans, and the people who are signing the loans are saying it'll be fine, just make sure they make the first payment. They have no credit, we know they're not going to make the payment, their second or third, they don't have any money, and then eventually it's a deck of cards. It's just house of cards. It just folds
because the banks were getting rid of the loans. Yeah. They're like, we're going to package these things up, sell them as mortgage backed, right? So you've got a tangible asset behind it, and they sold them as very low risk because there's an actual asset, and everybody knows real estate only goes up, right? According to them back then, right? And so you got this like, institutions were saying this is a win-win, even if they default. That's great. We have a home that's appreciated in value that we can take back, and it obviously that wasn't a good idea.
My favorite part is that, like, politically, where it started, it turned over to a new regime or whatever, and then it fell, and so no one got the blame. Like it was,
you blame the previous administration, right?
No one got the blame. It just happens, and then everyone loses their shorts. And I remember thinking, like, we thought at the time that the whole banking industry was gone. Like we were in big trouble.
Yeah, it was a scary time.
Yeah,
and the banking industry did just about fold, right? And had the government not stepped in, there's a high probability that the banking industry would have completely.
That's a bubble.
Would look a lot different.
Yeah.
Yeah.
I mean, it may have been, it would have been resurrected as something different. Right. Whether it was at that point completely socialized, right, or not. And so it would have looked very, very different. But as opposed to that, the government stepped in and did the bailouts, and you can argue, pros and cons on that. But that's what the repercussions of fads and trends and bubbles, it does have massive implications for you and your investment portfolio and for your goals. And so making sure that you're in tune and self-aware enough of, okay, what is a fad versus a trend versus investing in something fundamentally is critically important for you reaching your goals, because you don't want to get caught up with the bulk of your investments and assets being allocated towards, in 2007 and 2008 in real estate that's going into a bubble territory, because you're not going to see the bubble. You're not going to be self-aware enough to recognize the bubble. No, hardly anybody was, right? And then all of a sudden it gets cut by 80%, and you're just right along for that ride. You're not going to be able to react fast enough to do it. And then your entire retirement, everything you've worked for your entire life, has been hinged upon that thesis that was a wrong thesis.
Right. And I think the reoccurring theme for this podcast is going to be, what are the fundamentals, right? When I look at something and I look at the price that I'm paying for it, does that make sense? Like fundamentally, if I'm just, I Rip Van Winkle, fall asleep, wake up, and I'm looking at this investment opportunity, does that make sense for me to pay $100 here to get what in return? Right. And I think if people would ask themselves those questions when they're building their portfolios, when they're looking at investment ideas, it would help them think a lot more clearly.
Well, okay. So speculative investments would be things that we talked about gold, but precious metals, cryptocurrency, fine art, collectibles, early stage startups, or unprofitable companies. And Rex, but people still invest in these because the pros can be so high. Like you can get outsized returns. And so it's like, yeah, well, I can earn a lot of money, however, but it's still a speculative investment. When should people invest in something like that?
Well, I think if you have a specialized knowledge, right? Like if you're into art and you're, a collector of art, and you've studied art your entire life, and you've seen these different artists, go and increase and peak, and seen the value of their artwork continue to increase, and you've been a good, solid evaluator of that, then you certainly have a leg up on somebody like me that is not an art collector and is not an evaluator of art. And so if all of a sudden art gets into a fad and I'm like, oh gosh, I want to buy some nice art, and I just go buy it at the local gallery, I have no idea if I'm buying good art, bad art, right? And so I'm going to get caught up in that because I don't have the specialized knowledge.
Rex.
That's what they say.
Not if you're doing it as an investment.
Yeah, that's true. Yeah. So I think on the investment side, right, we definitely study investments,
right?
And we have degrees and licenses and things like that deal with financial investments, whereas the vast majority of the public do not. Now, some do, and some it's their hobby, and some are very, very good at it. And if that's you, absolutely, you're right. I'm happy for you. I'm cheering you on. I'm going to be your biggest supporter. Unfortunately, the vast majority are not, right? Their specialty might be in mechanics. Their specialty might be in engineering. Their specialty might be in medicine. And so, and not in investments. They may dabble, right? And I think that's where you need to hire professionals in the areas where you're not a professional.
Yeah, I think another one that's not on this list is options contracts, right? Within the stock market, you can buy options, and the thing about options contracts is they too are a zero-sum game, meaning that every dollar you make in the options contract world is you're effectively taking from someone else, and every dollar you lose is going to someone else. And we see investors, when they're getting started, they learn about options contracts, and they're cool. I mean, it's fun to look at them and to see the potential and see how much of the market you can control with a fairly limited amount of dollars in, right? There's a lot of cool things you can do with options contracts, but people get really excited about that. And the thing I always have to remind them is like, all right, you're going to go place these, you're going to go into these options contracts, but it's you against all the other institutional money out there, right? Full teams of analysts who all they are doing all day is studying and anticipating. And every dollar that you win is going to be essentially taken from them, right? Are you going to be able to predict market future, adjustments and everything else better than they do? And unfortunately, the people get into it, and that's probably one of the number one places I see people lose a ton of money is in the options trading space, because it's them and they've got a hunch and they're putting money, like tons of money on it because they think it's a great, but they're not seeing the full picture. And I see people all the time lose incredible amounts of money in the options realm.
So that would be a con.
That is a con, sure.
Literally.
And also, you have listed, Brandon, no predictable income, hard to value, can drop to zero on some of these speculative investments, and highly volatile.
Yeah, most can.
Yeah, almost all investments can drop to zero, right? It's just a matter of what is the probability based on their earnings and stores and their inventory and things like that they do drop to zero. And so you get into bigger companies, whether it's big lumber companies or big retail companies or big utilities or things like that, and they have a very steady stream of income that's going to flow through. They have a good solid base of assets. Things like that. And so I think one of the other really speculative areas is day trading, right? Day trading became very, very popular during the dot-com bubble and got kind of into that fad territory. Now it's never gone completely away, although I would argue that studies show that the vast majority of people that do day trading lose money on day trading. They get wooed away and trying to do it by the excitement of quick, easy gains, of people that promote that they can try and predict the markets, or this software is going to show when to buy based on the candlestick pattern or based on some Fibonacci reading or things like that, and
which
yet,
are all technical. Rex isn't just making up words there.
I'm not.
Yeah, I've heard Fibonacci before. I can't remember what it means.
We had a podcast talking about
yeah.
the Japanese term Fibonacci and how that works. But so just go and search out our podcast.
Yeah, you should. And I really kind of want a day trader to go head to head with like a sports market better guy and see who comes out on top after 6
or the monkey
months.
that was throwing darts.
Yeah. Like, right. So who's, I mean, people do make a living day trading, but that's not easy.
It's not easy, and the vast majority are not going to do it because they either take breaks away from it, they get distracted, or they don't stick to their strategy during the difficult times. And so their strategy when you don't stand for something, you're going to fall for anything, right?
That sounds good on the internet, though, day trading. Work
easy,
from home.
Easy to market and sell.
Yeah. Easy. Okay.
And some people can do it, but so often there's a deeper story. I remember I was way early in my career, and a guy I was working with was meeting with a couple. And this guy was just like, why would I invest with you when I can do 30-40% rates of return? He's going, and the guy's like, well, I don't know. Well, why are you here? And he just went on and on about all this money he's making day trading. And he's like, do you have a bathroom? He's like, oh yeah, just right back there. He leaves. His wife leans over. He's like, he's not telling you about all the money he's lost. Like, we've lost so much money that, and like, there's just two sides to every story, and when people start to tell me about all the money they're making, I'm happy for them. But before I believe it, I want to see a statement. Like, I want to see your annual statement, and I want to see your rate of return. And rarely do people get excited about showing that.
And that's the thing at parties, right? Everybody wants to talk about their big win and how they made it and things like that. And rarely are they sharing all the losses that have led up to that.
Or all the time they sat in cash and all the,
Right, all the lost opportunities, things like that. And so, you've really got to read between the lines of, okay, they hit this one, and how many did they miss to hit the one?
Yeah, you'll never know.
You won't.
Yeah.
You'll
Unless you see a
never know.
statement.
Yeah, unless
But people hide those.
unless you're a forensic accountant going through statements. Yeah.
All right, Brandon, you have some more numbers. It is that time of the podcast when we slip into our mood of going out by the fireplace or fire pit, I should say, and grab some marshmallows.
I love some
chocolate.
s'mores with some Hershey's chocolate.
And it's
graham
February and
crackers.
cold, and our friends on the East Coast are going into this 2-week depression of 10 degrees or lower or whatever. But s'mores season is coming.
We were in
And
Target, and they had a s'mores press, a little
for real?
a little appliance, right?
What?
Where you can you set in your graham cracker, you set in your marshmallow and your chocolate, and then you set in a little sleeve for a graham cracker on top. You press it down like a little panini.
Yeah.
And you smash it
That
down.
way you don't have to squeeze with your fingers like
Right.
the old days. Man,
Melts it all together, and you open it up, and out comes your s'mores. And
I
so
mean, cool, but
it doesn't have the same ambiance.
yeah, it doesn't have the same. Yeah.
Yeah.
But we use it for numbers here on this podcast,
Yeah.
Brandon.
And I've still got to just push this out. I've been trying this for years. But if anybody can talk to a chocolate executive and just make a waffle chocolate for s'mores, that way the marshmallow is somewhere to squish
because
into the
Hershey
holes.
bars are kind of reversed waffle. They need to
Sure,
be
right.
they
But
gotta
I need
flip
more
that.
space. Yeah.
Yeah.
I'm just trying to hold on. Anyway, I don't need any royalties. I just need the chocolate.
We just need
in
to happen.
a waffle
Yeah.
form.
Amen.
Yeah.
Right.
Anyway, some more numbers. So this was PwC did a survey of 4,000 CEOs, and they reported that AI has helped them with revenues, or 30% of those 30% of the 4,000 CEOs reported that AI has increased their revenues in the last 12 months. And so I thought that was interesting. AI is still relatively new, right? And what does that mean that it increased your revenues? I don't know, fairly subjective, right? But kind of interesting to watch this slowly make its way into the marketplace.
So meaning that 70% of the company, right? So 2,800 of the companies, it either they haven't incorporated any AI yet, or the AI that they've incorporated is not increasing their earnings.
Correct.
So far.
Yep.
Interesting. Yeah.
And that's one too that everybody wants to be the first to say, yeah, it's increasing our revenue, and so we'll see, right? It's still fairly new. I
That's
think
so hard to measure, right? I mean, I look at the different ways that we're utilizing AI in financial services at the moment,
right.
and it would be really difficult to tie
a dollar
yeah. of increased revenue directly towards
Well, because
our
it's not
AI
selling for
usage.
you, is it? It's not going out getting
Right.
new.
Right.
But it is saving us time, and I could put a quantity on number of minutes, and then I could put a quantity on how much my time is worth, and kind of. But
And then if you're able to use that
extrapolate
time to go get more
Right.
money under management, that would be a
right.
thing.
But to Rex's point, that's a
Yeah,
stretch.
it is a stretch. It's so much work and time to go in to calculate that on such a. You're going to waste all your savings, all your
AI
efficiencies on doing
on
the
bragging
calculation.
about your
Yeah.
probably. But kind of
Interesting.
fun to-
I am super excited about AI and the innovations and the
too.
changes to the industries that we're going to see and the efficiencies that we're going to see. I'm super excited for it as it continues to develop.
Well, let's talk about investing in fundamentally sound stocks. So ownership in established companies with actual earnings and diversified business models and long-term growth potential. Would this be now? Amazon, it was Microsoft. There's another big tech company that kind of fell off the face of the earth, but everyone invested in a few years ago. And it's big companies, right? We're talking about big companies. So mature companies with steady earnings, broad-based ETFs, diversified portfolios. They're typically referred to as, and the companies that I mentioned, they fit in the box of what would be called a blue chip company, right, Rex?
Yeah, maybe. I mean, I think smaller companies can have strong fundamentals too. And so I don't think it's necessarily size dependent to where only $1 billion revenue size companies and above have fundamentals. I think you can find companies with, 500 million of revenue that have strong fundamentals, strong earnings, and strong growth that you can invest in as well. So I don't think it's just size, but I do think that, the core parts of your portfolios should be based on fundamentally sound investment principles. And that would be making sure that, we're investing in companies that have earnings and continuing to grow their earnings. Maybe that some of them are paying dividends and continuing to grow their dividends. And these may be packaged in different, mutual funds or exchange trade funds, or you may own the securities individually as individual stocks. But I think that the core of your portfolio should be a very well diversified core that's based on fundamental investing.
Okay. Brandon?
Yeah, you never know what companies are going to go out of business, right? Like companies are going to make poor decisions. Executives are going to make the wrong call. They're going to say, hey, the market's going this way when it's going that way. But that's where diversity comes in, right? And the amount of stability that comes from having hundreds of very stable companies with years and years of dividends and dividend growth, and there's quite a bit of stability and safety in that. I think there comes a point in every investor's life where they realize that there truly is no safety anywhere in life financially, right? Like you can't just put all your money in cash under your mattress, because it can as we've seen time over time in history, it can be inflated away, right? Like one bad policy move and next thing you know, all that cash is worth much less. You can't just go like buy a bunch of gold and bury it somewhere, right? Like the value of that can literally cut in half, right? And not come back for 20 years. You can't, like there's no perfect solution out there. And so the answer seems to always come back to diversity, right? Like having your eggs spread out in various baskets so that, a lot of different scenarios could happen and you're still going to be all right. You're still going to have money. You're still going to have growth. Why are you laughing at me?
Because I just had a thought, and I can hear now people in our audience, especially those that are in the insurance industry, saying the perfect solution is annuities.
It's an annuity, right?
I can just see it right.
But man, like I was thinking about this yesterday. People love annuities because they provide a quote guaranteed income, right? And but the problem is, you're literally putting all of your eggs in one company. If that insurance company goes under, like that's it, right? All those
multiple annuities. Multiple companies.
You could do that, right? But the problem is, the irony of that is now all of a sudden you've got all of your eggs in one sector, the insurance financial sector. And if something crazy happens with that sector, you're right. Like this, the greatest irony. I was listening to that song on my way here. Isn't it ironic? The greatest irony of all of this is that the places where people feel the most safe oftentimes aren't. And if you can just accept some movement, if you can accept some fluctuation in your life and be able to be flexible, that seems to have the highest probability of a successful outcome.
Rex, I'm reading The 50th Law written by Robert Greene, but based off of 50 Cent's life.
I just downloaded that
you
on
did?
your recommendation. Okay. I haven't listened to it yet.
Okay, it's really good. And here, the basic, this is the basic, what you get out of it, the lessons, I guess, would be diversification and ownership. Fearlessness is the main umbrella, but through diversification and ownership. And the way 50 Cent learned this is he was hustling the streets at 12 years old, and he learned that he had to diversify quickly on the streets in order to make any money and compete amongst other hustlers who were doing this previous to him, right? And it's always changing, and he's always had to do a little bit here and a little bit there, and when something didn't work, he'd quit that one and do something else. Like it was always changing and dipping into different fields. And so when he became a rap star and was in the media business and business entrepreneurial business, same thing. He would kind of just do a little bit over a lot of different things, and ownership, but buying companies, and when something didn't work out, quick to shut it down and move on to something else. And it's just like, well, that's like owning a bunch of stocks. Like you own like he's diversifying his business portfolio, and he learned that as young, and also owning as much as you can. And it's because, Brandon, you're like you said, like you're never safe, so you gotta like spread it out all over the place or whatever.
Yeah. Ownership is key, right?
Yeah.
And so when you're buying an annuity, you're giving up ownership and you're transferring that money to an insurance company. Now the insurance company owns the stocks, owns the companies, and in exchange for you transferring that risk to them, they're going to give you a rate of return within a range or a fixed rate of return, depending upon the type of annuity, in exchange for that. So you're just transferring risk to them for a cost, yet you're giving up the ownership rights. And so I think 50 cents dead on as far as ownership for your risk assets, diversifying, right, to reduce the overall risk of the overall, investment portfolio. But I think that's an interesting that he learned that at such a young age, and yet here we are still trying to convince a population of, pre-retirees, 50, 60, 70-year-olds that ownership and diversification is the right answer.
Right.
So it's interesting.
Yeah. So what are some downsides to investing in fundamentally sound stocks, Rex? Some examples that Brandyn supplied was that there's still some market volatility. It does require patience and some discipline, and there's low thrill factor. I like that one. Yeah.
But those are real challenges. Right? Because you're going to hear a neighbor about, or somebody at work or a family member say, "Oh my gosh, you need some of this," and I always call it, I need some of that kind of syndrome, to where something's gone up significantly, and now all of a sudden you need to buy it after it's doubled or tripled in price, because you have FOMO, you have fear of missing out, right? And yet the gain has already occurred, and I think that is the concern with those issues is you do have to be patient. You do have to realize that it is a long game of getting a good long-term solid rate of return. You will still have some volatility, and so it's still going to test your patience over time. You're still going to have bear markets and down markets and economic recessions that you have to wade through, and it's going to challenge your investment thesis. It's going to challenge your patience to ride through those things. So I think those are some of the challenges of staying core to your beliefs by investing in fundamentals.
Brandyn, let's talk stability and predictability in fixed income options. I guess you didn't include annuities on your list here, by the way. So bonds and CDs and things.
Yeah, and it's not the annuity. Rex and I are there. You get some advisors that just love annuities, right? And it's like comical. Even some firms that, like, if I see a proposal, if someone comes to me with a proposal from a certain firm, I know there's going to be like 30% of their whole portfolios in an annuity, no matter what. Right. Like, and there's multiple firms that do that. And it's a fixed indexed annuity and everyone's being smashed into that. And Rex and I don't agree with that at all. With that said, there are some times where people just say, you know what, I cannot handle market volatility. I don't like the market. I panic every time. I'd rather have an insurance company promise me a steady set of income, and then maybe we do that with part. But that's definitely not our go-to. It could just because I for a lot of reasons, I think we have other podcasts on that. But as far as fixed income, so this is like bond type funds, right? So bonds or individual bonds or certificates of deposit, CDs, things that have a stated fixed income, which is essentially, you pay someone money like a municipality or a corporation or the federal government, and they're going to pay you a fixed rate, 3% or 5% every year for a fixed number of years, and then they give you your money back.
This almost sounds like a deal with the devil.
I wouldn't go that far.
Well, only yeah, I know. What I mean by that is, because like you are turning over, like you said, flexibility, I guess, or ownership to something, and then you for a guaranteed payment, and then that's it. That's what you get.
Right.
Yeah, it's just a trade-off for your conservative money, right? When I came into the industry, I learned fixed income as kind of what we call permanence and definition, right? You have a defined income stream, and the permanence is the return of your principal. You put $10,000 in, you're going to get $10,000 back in 5 years or 3 years or 20 years, depending upon the type of bond, as long as a lot of times they're insured by additional companies, or a lot of times, that you're dealing with a bank individually, or you're dealing with a municipality It might be an airport bond or something along those lines. And so I think it's just risk control. And so, we're wanting to make sure that our more conservative money is also based on fundamentals, right? That if you're buying a CD, that we're within, the FDIC insurance limits, that we're, it's covered, and that the bank is going to be there when the CD matures to give us our money back, because we're just loaning the bank our money for them to pay us an interest rate, just like they loan us their money to buy a car or to buy a house, and we're paying them an interest rate. A CD or a bond is the exact reverse of that. We're just lending the bank money for a guaranteed interest rate. It's just the opposite. So
yeah, and again, nothing is invincible, right? Like even a treasury bond, right? You're literally lending money to the mightiest economic force in the world, the United States government. And what is their power? Their power is to tax. They have the ability to tax. And are they going to ever lose that? Probably not, right? And so you look at like treasuries as one of the most secure investments out there. But even that, right? You buy a treasury bond, and what happens if you buy a treasury bond paying 3% and interest rates go up? Well, who wants your treasury bond that's now only paying 3%? Nobody, right? And so if you want to sell it, you have to sell it at a discount. And so again, even in the safer assets, there's still risks. And I think what it comes down to is the diversity and understanding what the risks are and how these all work together in a down market or in an up market and everything in between.
Awesome. Anything else, Rex?
No, avoid fats. No, I'm just kidding. Be smart.
Yeah, be smart. Be smart. And you'll probably have questions. I'm sure. Hopefully you learned something on this particular episode of Through the Pines, going over fads, bubbles, speculations, and fundamentals. But you will have questions. Reach out to Rex and Brandyn at planwithbaxter.com. Weird, but the internet doesn't close. It's 24/7. So you can actually just go there at 3 a.m. and go to planwithbaxter.com. Now, they might not answer that fast. So, but planwithbaxter.com is how you can get a hold of these two wonderful gentlemen here joining us on the podcast. So thanks so much. This podcast was produced by the Brandyn Collective and recorded in our Cap Trailer studio, located inside the Monarch building here in the Nine Rails Creative District on historic 25th Street. If you found value in the podcast, which I'm sure you did, you can give a little cash over to buymeacoffee.com/BrandynMedia. Find us on YouTube, where you can see our wonderful, beautiful faces at Through the Pines, and like our Facebook page, Pines Podcast, and then we throw some shorts up there on Instagram as well. And so that's Pines_podcast. Thanks for joining us. We'll see you on the next Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.